Andy Tuttle with the Tuttle Group here to give you this week's market update. Now, stocks and bonds are both lower to start the week here, and mortgage rates have actually risen 0.5% since their low on September 17th. That was the day of the Fed meeting. Like we've been saying, when the Fed lowers their rates, the Fed funds rate, that does not mean mortgage interest rates lower. In fact, many times they go in the opposite direction. Last Friday's jobs report didn't help either. They didn't help rates either, the stronger than expected jobs report, and rates have gone up 0.25% since last Friday morning. Luckily, if you've been watching our videos and taking our advice, you're already locked in. You got locked in before the spike, and if we're monitoring your rates for you, obviously we protected you before that report too. Now, if you're not sure if your lender locked you in, I would reach out to them right away and just confirm you're locked and protected. And if you don't get a good answer, hey, reach out to us. We are happy to help and we'll take good care of you. This week, we got a busy economic week. There's a lot on the calendar. We've got a parade of Fed members talking on Wednesday. We've also got several key reports. Now, we're going to be watching all of them, but the two that we're going to be watching the most are the CPI, Consumer Price Index, and the PPI, Producers Price Index. CPI comes out Thursday, PPI on Friday. These are big inflation reports that the Fed likes to look at and everybody else to see what's going on. If the rate of inflation in those reports shows that it's continuing to slow, well, it may give some basis for some rate improvement and another rally. But if inflation still looks like it's going high, well, that's just going to fuel mortgage interest rates going higher, at least in the short term. So here are a few tips to remember if you're out there in this market trying to look to buy a home. Sellers are more willing to negotiate right now, so make sure you make the most of it. We've got that Inflation Buster program. If you and your realtor negotiate roughly 2% of the sales price, that's going to get you a 2% below market rate for the first year, or 1% below market rate for the second year. It just builds a bridge until rates drop more permanently, as they do in cycles. And we've talked about this a lot. And the Fannie Mae projected rate is around 5% is what they're expecting by the end of 2025. They've moved the ball a lot, but we've been saying into 2025 for a long time, maybe beginning of 2026. Either way, the Inflation Buster program will help you build a bridge to have low rates until that happens and you can refinance and get that rate more long-term. We're happy to talk to you about that, so give us a call as well. If you are looking to refinance and you feel like you just missed this last opportunity, don't worry, but don't miss the next one, okay? Reach out. We want to help you get your target rate or your strike rate, right? That's just the rate where it makes sense to refinance, where the savings make up the cost in the allotted amount of time, the metric that we have for that. That's what you want to look at. And that way, when the next rally comes, you can act right away. Because look, these opportunities, especially to refinance, they're fleeting, right? The market can change like that, and then it can be weeks or months before you see those opportunities again. So it's important to get ahead of it. But regardless of your plans, just know we're in your corner. We're your friends at Home Finance. We want to help. And I'll say what I say every single week lately. It's going to be a bumpy ride. But don't worry. You get a great team. You have good strategy. You can win in any market. So don't worry about it. We're going to help you get through it. And of course, if you have questions, we're just a phone call away. So good luck out there. We appreciate you. Until next time, remember to be the Buffalo. Thanks for watching.